Welcome to Finance Frontier AI, where finance meets the future. I'm Sophia, and with me is the ever-insightful Max Vanguard. Today, we're broadcasting from the heart of innovation, New York City. Known for its iconic Wall Street and bustling financial district, New York is the perfect backdrop for our deep dive into the latest AI advancements and financial trends. Today's episode is titled, AI and Finance Revolution. Live from the heart of innovation, New York City. Max, tell us what we have in store for our listeners today.
Absolutely, Sophia. It's fantastic to be here in New York City, a city that epitomizes financial innovation and dynamic energy. In today's episode, we'll cover the latest U.S. consumer confidence trends and their impact on the economy, delve into how central banks are preparing for the profound impact of AI in finance, and explore a promising trade opportunity with Bit Digital Incorporated, BTBT. We'll also discuss a smart bet for the MLB game between the Minnesota Twins and the Seattle Mariners and recap a successful bet on the Sporting KC versus Austin FC match. Stay with us as we break down these crucial stories and give you the insights you need to stay ahead in this fast-evolving financial landscape.
Before we dive in, we want to remind you to share this episode on Twitter and help us spread the word. You can find the link to our Twitter profile in the show notes. And if you haven't already, make sure to subscribe to Finance Frontier AI on Apple Podcasts or Spotify to stay updated with our latest episodes. Your subscription helps us climb the charts and reach more listeners. Hit that share button, and let's make this conversation go viral. Welcome back to Finance Frontier AI. Today we have a thrilling lineup of the latest finance and AI news, coming to you from New York City. This place is known for its vibrant tech scene and innovative spirit, making it the perfect backdrop for our discussion. Let's dive right into it. Let's start with the latest on U.S. consumer confidence.
Indeed. Recent data shows a decline in U.S. consumer confidence due to a muted outlook for business conditions, the job market, and incomes. According to a report from Yahoo Finance, consumer confidence has dropped, reflecting concerns about future economic stability. This decline could have several implications, including reduced consumer spending, which is a critical driver of economic growth. When people are less confident about their financial future, they tend to cut back on spending, which can slow down economic momentum.
That's quite concerning. How might this impact different sectors of the economy?
Lower consumer confidence typically affects sectors like retail, hospitality, and automotive the most, as these rely heavily on discretionary spending. Businesses in these industries may see reduced sales, leading to potential cutbacks in hiring or investment. Moreover, the job market might experience slower growth as companies become more cautious about expanding their workforce amidst uncertain economic conditions.
In market news, we see mixed trading as Nvidia makes a cautious comeback after a recent sell-off, lifting the Nasdaq.
That's right. Nvidia, after experiencing a significant sell-off, has managed to turn a corner, which helped lift the Nasdaq. This recovery was particularly notable as it brought some much-needed optimism to the tech sector. According to Yahoo Finance, Nvidia's resurgence has been a crucial factor in boosting investor sentiment. Additionally, a surge in tech stocks, led by Nvidia and FedEx, has significantly boosted the U.S. stock market. FedEx shares, in particular, jumped 15% in after-hours trading, showcasing strong market performance in the tech and logistics sectors.
It seems like tech stocks are playing a crucial role in the market's overall performance.
Absolutely. Tech stocks have been a major driving force behind the market's resilience. Another interesting development is the dip in oil prices by 1%, which was driven by weak U.S. consumer confidence data. This dip raises concerns about the economic outlook and fuel demand. Meanwhile, U.S. house prices have increased steadily in April, despite higher borrowing costs, according to the Federal Housing Finance Agency. This steady rise in house prices suggests that demand for housing remains robust, although higher interest rates may eventually slow this momentum.
It's fascinating to see how different factors are influencing the market. What are your thoughts on the overall market trends?
The market is currently navigating through a mix of positive and negative signals. On one hand, the recovery of major tech stocks and steady house prices indicate underlying strength in the economy. On the other hand, declining consumer confidence and the impact of higher borrowing costs pose challenges. Investors are closely watching these developments to gauge the future direction of the market.
Next, let's highlight some significant reports and initiatives. Yooz has released its fourth annual report on the state of automation in finance, which provides key trends and insights into the future of financial automation.
Yes, the report by Yooz highlights how automation is transforming the finance sector. Key trends include increased adoption of AI and machine learning to streamline financial processes, reduce errors, and enhance decision-making. This shift towards automation is driven by the need for greater efficiency and accuracy in financial operations. Businesses are increasingly leveraging these technologies to gain a competitive edge and improve their financial performance.
That's impressive. What are some of the key takeaways from the report?
One of the main takeaways is that automation is no longer just a trend, but a necessity for staying competitive in the finance industry. The report emphasizes the importance of integrating advanced technologies to handle repetitive tasks, allowing human workers to focus on more strategic activities. Additionally, the report highlights the growing role of cloud-based solutions in facilitating automation and enhancing data security.
Let's move on to the launch of a new litigation finance firm in the U.S., with over $100 million in capital. This seems like a significant development.
Indeed, it is. The launch of this new litigation finance firm, as reported by Australasian Lawyer, marks a major milestone in the legal tech space. The firm focuses on commercial and patent litigation, providing substantial financial backing to legal cases. With over $100 million in capital, the firm aims to support innovative legal strategies and ensure access to justice for businesses and individuals involved in complex litigation. This development underscores the increasing intersection of finance and legal technology, driving innovation and efficiency in the legal industry.
Finally, let's touch on the U.S.'s pledge to be a leader in climate finance while defending gas expansion. What are the key points here?
John Podesta, Biden's top climate official, has called for major economies to aid poorer nations in combating climate change, while also defending the U.S.'s gas expansion efforts. According to The Guardian, this dual approach aims to balance the need for economic growth with environmental sustainability. The U.S. pledges to lead in climate finance by providing significant funding and support for green initiatives globally. At the same time, the U.S. is promoting natural gas as a transitional energy source, which can help reduce carbon emissions compared to coal and oil.
That's a complex but important balance to strike. It's clear that the U.S. is trying to navigate both economic and environmental priorities. Welcome back to Finance Frontier AI. Today, we're diving into some major developments in the world of AI. From central banks preparing for AI's impact to legal battles over AI-generated music, we've got a lot to cover. Let's get started. Let's begin with a significant report from the Bank for International Settlements.
The BIS advises central banks to brace for AI's profound impact, suggesting major changes in how monetary policy is conducted. According to Reuters, the BIS highlights the need for central banks to harness AI's benefits effectively, ensuring financial stability and economic growth. This includes developing new frameworks to manage the risks and opportunities presented by AI. Central banks must adapt to technological advancements to maintain control over economic systems.
That sounds like a major shift in the financial landscape. What kind of changes are we looking at?
The BIS report mentions several areas, including enhanced data analytics for better decision-making, automated processes to increase efficiency, and new regulatory measures to handle AI-related risks. These changes aim to create a more resilient and responsive financial system that can handle the complexities introduced by AI technologies. For instance, AI-driven data analytics can provide more accurate economic forecasts, allowing central banks to make more informed decisions. Additionally, the automation of routine tasks can free up human resources for more strategic initiatives, improving overall efficiency and effectiveness in financial management. AI can also help in monitoring and managing financial markets by identifying emerging risks and opportunities, thus enhancing the stability and robustness of financial systems. The integration of AI into central banking processes could lead to a paradigm shift in how monetary policies are formulated and implemented, potentially resulting in more dynamic and responsive economic management.
In advertising news, Toys R Us has made headlines with an AI-created ad.
This ad showcases the potential of AI in marketing, allowing for highly tailored and innovative campaigns. As reported by CNN, Toys R Us used AI to create a brand film, demonstrating how AI can produce engaging and personalized content quickly and efficiently. This approach not only saves time but also opens new possibilities for creative storytelling in advertising. By analyzing vast amounts of consumer data, AI can help marketers create ads that are highly relevant to target audiences, increasing engagement and conversion rates. For example, AI can predict which products a customer is likely to be interested in based on their past behavior, leading to more personalized and effective advertising campaigns. Moreover, AI tools can optimize ad placements and budget allocations, ensuring that marketing resources are utilized in the most effective way. The ability to quickly generate and test different ad versions allows companies to be more agile and responsive to market changes, potentially revolutionizing the advertising industry.
It's fascinating to see AI being used in such creative ways. What impact do you think this will have on the advertising industry?
AI has the potential to revolutionize advertising by providing more personalized and targeted content. Marketers can leverage AI to analyze consumer behavior and preferences, creating ads that resonate more with audiences. This could lead to higher engagement rates and better ROI for advertising campaigns. Moreover, AI can optimize ad placements and budget allocations, ensuring that marketing resources are used more efficiently. For instance, AI can determine the best times to display ads to specific audiences, maximizing the impact of marketing campaigns. Furthermore, AI can assist in creating dynamic content that adapts in real time to user interactions, enhancing the overall consumer experience. As AI continues to evolve, we can expect even more sophisticated tools that can automate the entire ad creation process from initial concept to final deployment, significantly reducing the time and cost associated with traditional advertising methods. This shift could democratize access to high-quality marketing tools, enabling smaller businesses to compete with larger firms on a more level playing field.
Moving to the music industry, major labels are suing AI startups over copyright issues.
Sony, Universal, and Warner have filed lawsuits against AI startups for allegedly infringing on music copyrights. According to the BBC, these labels claim that AI-generated music created by these startups violates their intellectual property rights. This legal battle raises significant questions about the ownership and rights of AI-generated content.
This seems like a complex issue. What are the implications for the music industry?
The lawsuits could set important precedents for how AI-generated content is treated under copyright law. If the courts side with the record labels, it could lead to stricter regulations and more challenges for AI startups in the creative industries. On the other hand, a decision in favor of the startups might encourage more innovation but also necessitate new legal frameworks to protect intellectual property. This could spur further advancements in AI-generated content but would require careful consideration of ethical and legal standards to ensure fair use and protection of original creators' rights. Additionally, the outcome of these lawsuits could influence how other industries approach AI-generated content, potentially shaping the future of creativity and innovation. The music industry, in particular, may need to develop new models for collaboration and revenue sharing that recognize the contributions of both human artists and AI technologies.
There are growing concerns that Europe might overregulate AI, potentially falling behind the US and China.
Prince Constantijn of the Netherlands warns that stringent regulations in Europe could stifle AI innovation, making it harder to compete with the US and China. CNBC reports that Europe's approach to AI regulation focuses heavily on ethical considerations and safety, which, while important, might slow down technological advancements. In contrast, the US and China are adopting more flexible regulatory frameworks that encourage rapid AI development.
It's a delicate balance between regulation and innovation. How might this affect the global AI landscape?
If Europe enacts overly restrictive regulations, it could see a talent and investment drain to regions with more favorable environments for AI development. This might hinder Europe's competitiveness in the global AI market. Conversely, a balanced approach that ensures safety without stifling innovation could position Europe as a leader in ethical AI development. The challenge lies in crafting regulations that protect public interests while fostering an environment conducive to technological progress. By collaborating with industry stakeholders and adopting a flexible, adaptive regulatory framework, Europe can strike a balance that promotes both safety and innovation. Such an approach would not only enhance Europe's position in the global AI market, but also set a precedent for other regions to follow.
In corporate news, Stability AI has raised $80 million and appointed a new CEO.
Stability AI's recent funding round, reported by Reuters, brings in significant capital aimed at driving the company's growth and innovation. The appointment of a new CEO and board members is expected to steer Stability AI towards achieving its strategic goals. This infusion of capital and leadership change is a strong signal of the company's ambitions in the AI space.
What can we expect from Stability AI moving forward?
With the new funding, Stability AI plans to expand its research and development efforts, focusing on creating advanced AI solutions for various industries. The new leadership is likely to bring fresh perspectives and strategies to enhance the company's market position and innovation capabilities. We can anticipate Stability AI pushing the boundaries of what is possible with AI, potentially leading to breakthroughs that could have wide-ranging impacts across different sectors. For example, they might develop new AI models that improve efficiency in manufacturing, healthcare, or finance, thereby driving innovation and growth in these areas. The company's commitment to advancing AI technology positions it as a key player to watch in the coming years.
OpenAI is taking steps to block access to its AI tools in China.
According to Yahoo Finance, OpenAI has implemented measures to prevent users in China from accessing its AI software. This move is part of broader efforts to control the distribution and use of their AI technologies globally. By restricting access, OpenAI aims to ensure that its tools are used responsibly and in compliance with international regulations. This decision highlights the complexities of operating in a global market where regulatory environments can vary significantly from one country to another.
How might this decision impact OpenAI's presence in the global market?
While this might limit OpenAI's market reach in China, it could strengthen its reputation for prioritizing ethical considerations and regulatory compliance. This decision also underscores the challenges tech companies face in navigating different regulatory landscapes around the world. By taking a firm stance on responsible AI usage, OpenAI could build stronger trust with regulators and users in other markets, potentially opening up new opportunities for growth and collaboration. This move might also encourage other tech companies to adopt similar measures, promoting a more ethical and responsible approach to AI development globally.
OpenAI has also delayed the release of new voice features for ChatGPT.
The Washington Post reports that OpenAI has postponed the release of ChatGPT's voice mode to conduct further safety tests. This delay highlights the importance of ensuring that new AI features are safe and secure before they are rolled out to the public. OpenAI's cautious approach aims to mitigate any potential risks associated with voice-based AI interactions. This delay is a reminder of the inherent challenges in developing advanced AI technologies and the need for thorough testing to ensure user safety and satisfaction. Ensuring these voice features are robust and free from vulnerabilities is crucial to maintaining trust and delivering a reliable product.
Welcome to Chapter 3 of our podcast, where we delve into practical strategies for trading, investing, and making money with AI. Today, we'll analyze a promising trade opportunity with Bit Digital Incorporated (BTBT), provide insights on a smart bet for the MLB game between the Minnesota Twins and the Seattle Mariners, and discuss a winning bet for the Sporting KC versus Austin FC match. We'll also touch on the concept of value betting and its long-term benefits. Let's get started. Let's kick things off with Bit Digital Incorporated, a company making waves in the digital asset and AI sectors. Max, can you give us a breakdown of BTBT's current financial performance?
Absolutely. Currently, BTBT is trading at $3.42 with a price target of $5.19 based on technical resistance and new contract information. The stop loss is set at $2.79, and the stock has a P/E ratio of 8, indicating it's undervalued relative to its growth prospects. The risk-reward ratio is excellent at 2.81 to 1, making it a compelling opportunity for investors.
What recent developments have contributed to this positive outlook?
Recently, BTBT finalized a significant contract expansion with a major high-performance computing (HPC) customer, increasing the total contract value to approximately $275 million. This expansion is substantial, given the company's market cap of $411 million. Additionally, BTBT reported an EPS surprise of 3,340% last quarter, significantly beating expectations and showcasing robust financial performance.
Those are impressive numbers. What do the technical indicators tell us?
Technically, BTBT is showing strong bullish signs. The breakout level is at $2.94, with significant volume almost 5x the average of the last 30 days, indicating strong buying interest. The stock is trading above key moving averages, including the 10 EMA, $2.76, 20 EMA, $2.80, and 50 EMA, further reinforcing the bullish trend. Support levels are at $2.94 and $2.89, suggesting strong price support around these levels.
With such positive technical and financial indicators, what's the investment thesis here?
BTBT presents a solid long-term growth potential due to its strategic contract expansion and impressive EPS performance. Its valuation, with a P/E ratio of 8, appears undervalued given its growth prospects. The technical strength, particularly the breakout above $2.94 with strong volume, suggests potential for further upside.
How should investors manage their risk with this trade?
Risk management is crucial. Setting a stop loss at $2.79, just below the 10 EMA, helps manage downside risk while allowing the trade to stay within natural price fluctuations. Additionally, adjusting position size based on daily ATR %, 10%, can help manage risk. For example, buying only 1/4 of the full size when the stock moves for X ATR % in a day can limit exposure to volatility.
Switching gears to sports betting, let's talk about the recent bet we shared on Twitter for the MLB game between the Minnesota Twins and the Seattle Mariners. Max, what insights can you share about this matchup?
The recommended bet was for the Minnesota Twins to win, with odds at 2.14 and an expected value, EV, of 20%. Despite a solid pre-match analysis, unforeseen events led to a loss in this case. This illustrates the randomness and unpredictability inherent in sports betting. Factors like in-game errors and key plays can significantly influence the outcome. However, focusing on high EV bets in the long run can lead to positive returns despite occasional losses.
In summary, the Twins versus Mariners bet was a loss due to the inherent randomness in sports betting. Always consider the risks and manage your bets responsibly. Now, let's move on to the Sporting KC versus Austin FC value bet that we also shared on Twitter. Max, can you give us a detailed analysis of this bet?
Certainly. The value bet placed on the Sporting Kansas City versus Austin FC match was a success. We recommended betting on over 3.0 bookings in the match, with odds at 1.526 and an expected value, EV, of 6.82%. Sporting Kansas City is known for high-scoring games and an aggressive play style, which typically results in more bookings. Austin FC, while having strong defensive capabilities, also sees a significant number of bookings in their matches. This high EV suggested that, on average, placing similar bets would yield a profit. The bet was successful, with the total bookings surpassing 3.0, resulting in a win and reinforcing the effectiveness of our value betting strategy.
That's a great example of using data-driven analysis to find value bets. What insights can we share with our audience from this bet?
The key takeaway is the importance of looking for bets with a positive expected value. By consistently analyzing team form, head-to-head records, and market trends, bettors can identify potential value bets. Additionally, leveraging AI and machine learning tools can enhance the accuracy of predictions, making data-driven decisions more reliable. Encouraging our audience to adopt a systematic, data-driven approach to betting can help them improve their chances of making profitable bets over time.
To recap, BTBT offers a promising trade opportunity with strong financial performance and bullish technical indicators. The recommended stop loss for BTBT is $2.79, and careful position sizing is essential. Meanwhile, the Minnesota Twins versus Seattle Mariners bet was a loss due to inherent randomness, but the high EV strategy remains valid. The successful value bet on the Sporting KC versus Austin FC match further illustrates the effectiveness of using data-driven analysis and value betting principles. Always perform your own research and manage risks carefully in both trading and betting. Before we wrap up, we want to remind our listeners that we shared this trade and bet analysis on our Twitter account with real-time updates. Following us on Twitter is crucial to getting the latest investment opportunities and insights as they happen. You can find the link to our Twitter profile in the show notes. Subscribe to our podcast for in-depth analysis and stay updated with the latest investment opportunities. Until next time, happy investing and betting. Welcome to Chapter 4 of our Finance series. Today we're diving into options and futures, two powerful financial instruments that can be used to hedge risk or speculate for profit. Can you start by explaining what options and futures are?
Absolutely. Options give investors the right, but not the obligation, to buy or sell an asset at a set price before a certain date. There are two main types of options: calls and puts. A call option gives the holder the right to buy an asset, while a put option gives the holder the right to sell an asset. This flexibility allows investors to leverage their positions and manage risk effectively.
That makes sense. Now, what are some common strategies for trading options?
There are several strategies for trading options, including buying calls or puts, selling covered calls, and using spreads and straddles to manage risk and potential returns. Buying calls or puts is a straightforward approach where investors bet on the price movement of an asset. Selling covered calls involves holding the underlying asset while selling call options against it, generating income while potentially capping upside gains. Spreads and straddles are more advanced strategies that involve buying and selling multiple options to limit risk and maximize returns. For instance, a bull call spread involves buying a call option at a lower strike price while selling another call option at a higher strike price, reducing the overall cost of the trade while capping the potential profit. Conversely, a bear put spread involves buying a put option at a higher strike price and selling another put option at a lower strike price, benefiting from a decline in the asset's price while limiting potential losses.
Great. Let's move on to futures contracts. What are futures and how do they work?
Futures contracts are agreements to buy or sell an asset at a future date for a price agreed upon today. They are commonly used for commodities, currencies, and financial instruments. Futures can be used to hedge against price changes or to speculate on price movements. For example, a farmer might use futures to lock in the price of their crop, ensuring they receive a certain amount regardless of market fluctuations. On the other hand, a trader might use futures to bet on the price movement of oil, aiming to profit from price changes. Futures contracts are standardized and traded on exchanges, providing liquidity and transparency. Each contract specifies the quantity and quality of the asset, the delivery date, and the settlement terms. This standardization makes futures an attractive tool for managing risk and speculating in financial markets.
I see. What are the key differences between options and futures?
While both options and futures are derivative instruments, they have key differences. Options provide the right but not the obligation to transact, whereas futures contracts obligate the parties to execute the transaction at the agreed-upon date and price. This fundamental difference affects how they are used and the risks involved. Options can expire worthless if the market doesn't move in the anticipated direction, limiting potential losses to the premium paid. In contrast, futures involve a binding agreement, which can lead to significant gains or losses depending on market movements. Additionally, options offer more flexibility and can be used in various strategies to hedge or speculate with defined risk, whereas futures are often used for hedging large positions or taking directional bets on market movements.
And what about trading strategies for futures?
Trading futures can involve strategies like going long or short, hedging against price changes, and using leverage to amplify returns. Going long means buying a futures contract to profit from expected price increases, while going short involves selling a futures contract to profit from expected price decreases. Hedging is used by businesses to protect against price volatility, such as airlines hedging fuel costs. Using leverage allows traders to control large positions with a relatively small amount of capital, magnifying both potential gains and losses. For example, a trader might use a futures contract to hedge an investment portfolio against market downturns by taking a short position in a stock index future. If the market declines, the gains from the futures contract can offset the losses in the portfolio.
Finally, let's talk about the risks and rewards associated with trading options and futures.
Both options and futures come with significant risks, including the potential for substantial losses, but they also offer the potential for high returns if used wisely. It's crucial for investors to understand these instruments and their associated risks before trading. Options can expire worthless, resulting in the loss of the premium paid, while futures can lead to large losses if the market moves against the position. However, with proper knowledge and strategy, they can be powerful tools in an investor's arsenal. Managing risk through diversification, position sizing, and stop-loss orders is essential for success in trading options and futures. Additionally, continuous education and staying updated on market trends can help traders make informed decisions and navigate the complexities of these markets.
Chapter 5, AI Series, Part 7 of 8, AI and Enterprise Applications. Today we're exploring how large businesses are integrating AI into their operations. Can you start by explaining why AI is becoming so important for enterprises?
Absolutely. AI is crucial for enterprises because it offers significant advantages in terms of efficiency, productivity, and innovation. AI-driven solutions like automated customer service chatbots, predictive maintenance systems, and AI-powered data analytics platforms are transforming how enterprises operate. These technologies help businesses streamline operations, reduce costs, and make more informed decisions. With AI, companies can process large volumes of data quickly, identify patterns, and gain insights that were previously unattainable.
How exactly does AI improve efficiency in these businesses?
AI improves efficiency by automating repetitive tasks, optimizing resource allocation, and enhancing supply chain management. For example, AI algorithms can predict equipment failures before they happen, allowing for proactive maintenance and reducing downtime. In logistics, AI can optimize delivery routes and inventory management, leading to faster and more cost-effective operations. Additionally, AI can handle administrative tasks such as scheduling, invoicing, and data entry, freeing up employees to focus on more strategic activities. This automation not only improves efficiency but also enhances accuracy and reduces the risk of human error in critical business processes.
How does AI enhance customer engagement?
AI enhances customer engagement by providing personalized experiences, anticipating customer needs, and improving response times through automation. AI-driven chatbots can handle customer inquiries 24/7, provide instant responses, and escalate issues to human agents when necessary. Additionally, AI can analyze customer data to offer personalized recommendations and tailor marketing efforts, leading to higher customer satisfaction and loyalty. For example, AI can track customer interactions across multiple channels, ensuring a seamless and consistent experience. This level of personalization and responsiveness can significantly enhance the overall customer experience, fostering stronger relationships and brand loyalty.
What role does AI play in decision-making within enterprises?
AI plays a crucial role in decision-making by providing actionable insights from vast amounts of data. AI-powered analytics tools can identify trends, predict outcomes, and suggest optimal courses of action. This allows business leaders to make data-driven decisions quickly and accurately, improving overall strategic planning and operational efficiency. For instance, AI can help identify market opportunities, optimize pricing strategies, and forecast demand with greater precision. By leveraging these insights, companies can stay ahead of the competition and respond more effectively to market changes.
How does AI impact enterprise productivity?
AI significantly boosts productivity by automating routine tasks, optimizing workflows, and providing actionable insights from data analysis. By freeing up employees from mundane tasks, AI allows them to focus on higher value activities that require human creativity and critical thinking. This leads to more innovative solutions and a more engaged workforce. For example, AI can streamline project management by predicting bottlenecks and suggesting ways to improve project timelines. Additionally, AI-powered tools can enhance collaboration by providing real-time data and insights, enabling teams to make informed decisions quickly.
What are some of the latest innovations in enterprise AI?
Some of the latest innovations in enterprise AI include advanced natural language processing for better human-computer interaction, AI-driven cybersecurity solutions to detect and respond to threats in real time, and AI-powered platforms for predictive analytics and decision support. These innovations are driving the next wave of digital transformation, enabling enterprises to stay competitive in an increasingly complex market. Additionally, AI is being integrated with IoT devices to provide real-time monitoring and analytics, further enhancing operational efficiency. For instance, AI can analyze data from IoT sensors to optimize manufacturing processes, improve product quality, and reduce downtime. These advancements highlight the growing importance of AI in driving business innovation and maintaining a competitive edge.
Now, let's introduce an innovative business idea: an AI-driven automated tax optimization service. This platform aims to revolutionize how individuals and small businesses manage their taxes. Max, can you start by explaining the market need for this service?
Absolutely. Many individuals and small businesses struggle with tax management due to the complexity of tax regulations and the time-consuming nature of the process. An AI-driven platform can simplify this by providing real-time analysis, personalized tax advice, automated filing, and compliance alerts. The demand for such solutions is growing as more people look for ways to streamline their financial management and ensure compliance without the hassle.
That sounds promising. What are the key features and functionalities of this AI-driven tax optimization service?
The platform offers several key features: real-time analysis of financial transactions to identify deductible expenses and tax-saving opportunities, personalized tax advice tailored to individual or business financial profiles, automated filing to streamline the tax filing process, compliance alerts for important tax deadlines and requirements, and integration with various financial tools and accounting software for seamless data transfer. These features make the platform a comprehensive solution for tax management.
What makes this service valuable to users?
The value proposition lies in its ability to reduce costs, minimize errors, and save time. By automating tax-related tasks, users can avoid the high fees associated with hiring tax advisors and accountants. The platform's accuracy ensures that tax calculations and filings are error-free, which reduces the risk of audits and penalties. Additionally, the time savings allow users to focus on other important aspects of their personal or business finances.
How would you go about developing and launching this platform?
The implementation plan involves several steps: conducting market research to understand the specific needs of the target audience, developing the AI algorithms and integrating them into a user-friendly interface, beta testing the platform with a select group of users to gather feedback and make necessary improvements, launching the platform with a comprehensive marketing strategy, and continuously updating the service based on user feedback and changes in tax regulations. Collaboration with financial experts and software developers will be crucial throughout this process.
What challenges might arise in developing this platform, and how can they be addressed?
One major challenge is ensuring the accuracy and reliability of the AI algorithms, which can be addressed by thorough testing and continuous updates. Another challenge is maintaining compliance with ever-changing tax regulations, which requires close collaboration with tax professionals and regulatory bodies. Data security is also a critical concern, so implementing robust encryption and security measures will be essential. Lastly, gaining user trust and adoption can be challenging, which can be mitigated by offering free trials, providing excellent customer support, and showcasing success stories and testimonials.
To wrap up, the AI-driven automated tax optimization service presents a significant opportunity to simplify tax management for individuals and small businesses. By leveraging advanced AI algorithms, this platform can offer cost savings, improved accuracy, and significant time savings. The implementation plan and addressing potential challenges will be key to the successful launch and adoption of this service. We hope this innovative idea inspires our listeners and provides valuable insights into the potential of AI in financial management. Stay connected. As we wrap up today's insightful exploration of AI in finance, we have a great question from one of our listeners who tuned into our Miami episode. They ask, in our Miami episode, we discussed the transformative impact of AI on healthcare, including how AI is improving diagnostic accuracy and enabling personalized treatment plans. How do you think these advancements will shape the future of healthcare, and what investment opportunities might arise from these innovations?
That's a fantastic question. AI's role in healthcare is indeed transformative. The advancements in diagnostic accuracy and personalized treatments are just the beginning. As AI continues to evolve, we can expect more efficient and effective healthcare solutions, leading to better patient outcomes. Investment opportunities will likely arise in AI-driven healthcare startups, biotechnology firms, and companies specializing in healthcare data analytics. These sectors are poised for significant growth as AI becomes more integrated into healthcare systems.
Now let's delve into the unique artworks that accompany our discussions. Max, there's more to these artworks than meets the eye, isn't there?
Absolutely. Our luxury conceptual digital art is not just a feast for the eyes, it's crafted with potential investment value in mind. Each piece is inspired by and linked to a specific chapter in our podcast, creating a unique narrative context that enhances its appeal. Drawing inspiration from the trajectory of Andy Warhol's iconic prints, which soared in value over time, we anticipate our artworks could similarly appreciate as digital and AI-influenced art gains broader recognition.
Warhol's work took some time to be fully appreciated, didn't it? How does that relate to our art?
That's right. Initially, Warhol's pop art faced skepticism and was met with mixed reactions. Some of his early works were priced modestly, often sold for a few $100s. Yet, over the years, these same pieces have appreciated enormously in value, with some reaching tens of millions at auctions. For instance, Warhol's 8 Elvises originally sold for $100,000 in the 1960s and later fetched over $100 million. We hope our art follows a similar trajectory, initially niche but growing in significance as the intersection of technology and luxury art becomes more mainstream.
And our listeners play a role in this as well, correct?
Indeed, they do. By engaging with our artwork on social media, especially on Twitter where we frequently post updates, our listeners help determine which pieces we feature. The most popular selections by our listeners are initially offered for sale on Etsy. Looking ahead, we're excited to announce plans for the Finance Frontier AI 2025 Art Collection, a future marketplace where these artworks will be traded like collector's cards. For truly standout pieces, we'll offer exclusive, limited edition artworks as NFTs, showcasing the best of our annual collections.
So, engagement from our listeners can influence which artworks are available?
Exactly. We encourage everyone to let us know if a particular piece captures their imagination. You can reach out through the contact form linked in our show notes or directly comment on our Twitter posts. This not only helps us gauge which artworks are most popular, but also fosters a vibrant community around this innovative blend of art and technology.
For our listeners who want to dive deeper and stay ahead with the latest developments, what do you recommend, Max?
I strongly recommend subscribing to our AI Finance 5 newsletter. It's your weekly summary of the top 5 insights from our podcast, crafted to give you a leading edge in AI and finance. Just fill out the contact form linked in our show notes, and every Friday, you'll receive a concise overview of crucial developments directly in your inbox.
Fantastic! And for those who want to continue this discussion and not miss any of our episodes, where should they go?
To ensure you never miss an episode, subscribe to us on Apple Podcasts or Spotify. Your subscription helps us climb the charts and reach more listeners, expanding our community of tech-savvy investors. Plus, it's the best way to stay updated with our latest episodes and the evolving world of AI and finance.
Thank you to everyone who has joined us on this journey. Your curiosity and engagement are what drive us forward. Stay connected, keep exploring, and together, let's uncover the future of technology and finance.
We hope you found today's discussion insightful. As always, our aim is to provide you with the most up-to-date and relevant information in the world of finance and AI. However, please remember that the content discussed in this podcast is for informational purposes only and should not be taken as financial advice. Always conduct your own research or consult with a qualified financial advisor before making any investment decisions.
We would like to acknowledge the sources that contributed to today's episode. The following news articles were referenced:
Yahoo Finance, Reuters, CNN, BBC, CNBC, Sky News, The Washington Post.
We want to thank these sources for their invaluable information that helps us bring you the latest and most accurate news in finance and AI. For more details and the full articles, please check our show notes for links to these sources.